We just finished discussing a common required income statement disclosure. It was the disclosure for earnings per share. Here I want to talk about another required disclosure, and this one is called comprehensive income. The formula that I have here in the middle of the slide is actually a pretty good description of what comprehensive income is. As the name suggests, comprehensive income is more inclusive. It's larger than net income, and I don't mean the number is larger, I just mean it includes more things than what net income includes. Comprehensive income is the combination of net income from the income statement and basically four types of gains and losses that feel a little bit like economic gains and losses, but because of their unique nature, they're not included on the income statement. So these things, all very specifically defined under U.S. generally accepted accounting principles, are considered to be other comprehensive income items, or OCI items. And when you combine net income with these four types of gains and losses that don't get reported as part of net income, you get this other value called comprehensive income that also must be disclosed every year to shareholders. Now, companies have choices as far as how they make this disclosure. They can either just include it on the face of the normal income statement where they start with net income, they adjust it for any other comprehensive income items in that accounting period, and then they compute comprehensive income from there. Or, and the second way is actually much more common in financial statements currently, most companies choose to actually just prepare a separate financial statement, and this statement is called the Statement of Comprehensive Income. And this is usually a pretty short statement because it just starts with net income from the income statement, and then they add or subtract the various types of OCI items that have happened during the current accounting period. Well, let's go ahead and take a look at this list of the four types of gains and losses that are considered to be and qualify as OCI, or other comprehensive income items. You can read through the list here. Certainly the bottom three are way beyond our scope as to anything that we would be talking about or trying to understand in this class, but as you read through the list you can see that basically these are types of gains and losses. Let's just take a look at the first bulleted item here, because this is probably the most common type of OCI for most companies. So this first bullet says is that an OCI item would be net unrealized holding gains or losses from certain types of investments. This category used to be much more inclusive than it is now. There's actually fewer types of investment unrealized holding gains and losses that are considered to be OCI now than there used to be. But let me give you an example. It's not, first of all, it's not all unrealized holding gains and losses from investments. It's just certain types of investments that will generate OCI, unrealized holding gains and losses. For example, it's generally this category of investments that are defined as available for sale investments. If a business invested in bonds of another corporation and they did not intend to hold those bonds until maturity, then that investment in those bonds would likely be considered to be an available for sale investment. Let's say that they paid $100,000 for those bonds, and at the end of the year those bonds are worth $105,000. The company would have what we would call an unrealized holding gain of $5,000. The bonds would show up on the balance sheet at $105,000 because generally accepted accounting principles would require them to show up on the balance sheet at their current value. The $5,000 gain is called an unrealized holding gain because the company hasn't sold the bond, they're still holding them. And that $5,000 of gain in this case would not show up on the income statement. Instead, it would be an OC item, and it would only show up in the computation of comprehensive income. So let's say that our business had net income from all other things of $500,000. Their $5,000 unrealized holding gain on their investment in that bond would be an OCI item. So the company would report comprehensive income of the $500,000 of net income plus the $5,000 of positive other comprehensive income. And comprehensive income would be $505,000 for that company. So as you see noted at the bottom here, realize that each of these things we're talking about here, net income, other comprehensive income, and comprehensive income, these are all items that are being measured for one particular accounting period, such as for a single year. Finally, the other thing I want you to understand about these other comprehensive income items is, if you think about it, they have to go to live somewhere in the balance sheet. So in my example that I talked about a few minutes ago, we had a business that invested in a bond. They had a balance sheet valuation on the bond at the end of the year of $100,000, but the value of the bond was $105,000. So I said they had a $5,000 unrealized gain. Well, they needed to mark that bond up from $100,000 to $105,000, so they increased assets by $5,000. In order for the balance sheet to balance, there needs to be another balance sheet effect of that unrealized gain that would be reported of $5,000. The balance sheet effect is in a shareholders' equity account with an equally confusing but actually fairly descriptive name here called accumulated other comprehensive income. So that $5,000, when you increase the investment account by $5,000, the other account that eventually gets increased is this AOCI account, or accumulated other comprehensive income. So what I said earlier is, let's assume that the business had $500,000 of net income. That net income, of course, goes to live on the balance sheet as part of retained earnings. Over here on the left, you see your basic statement of retained earnings. The $5,000 of OCI, on the other hand, ends up increasing the accumulated other comprehensive income equity account. So comprehensive income ends up being reported partially in the retained earnings account, the net income portion of it, and the other part, the other comprehensive income, goes to live in its own equity account called accumulated other comprehensive income. Of course, if a company has a net loss instead of a net income, that would reduce the retained earnings account. And similarly, a company can have other comprehensive losses instead of gains. Those would reduce the balance in the accumulated other comprehensive income account. All right, the remainder of this video will just give you a little bit more detail on how we account for discontinued operations. You saw this slide earlier. It's just summarizing for you the difference between an income statement that did not have a discontinued operation and one that did have a discontinued operation. The important difference here, as you saw earlier, is that in order to give the investors information about permanent earnings, we want to separate out the earnings and any gain or loss that results from the sale of a discontinued operation, so that when an investor looks at the income from continuing operations line of the income statement, they're seeing the results of the parts of the business that are still going to be there next year. What I want to do here is give you a little bit more information about what qualifies as a discontinued operation. Companies have a discontinued operation when they dispose of a business component or if they have a business component that they haven't disposed of yet, but it's being held for sale at the end of the year. There's a couple of caveats here. These things are required. Both of these things are important in order for a company to report a discontinued operation. First of all, the disposal has to represent a strategic shift, and it has to have a major effect on the operations and financial reporting of the company. Strategic shifts include things like the disposal of operations in a major geographical area or the disposal of a major line of business for a company. In addition, the disposed item must be a business component, and we define a business component as you see down here. A business component is any part or division of a business that includes operations and cash flows that can be clearly distinguished, both operationally and for financial reporting purposes, from the rest of the entity. So this is actually, it may not look clear, but this is actually a very practical definition. So that, let's say, let me give you a highly simplified example here. Let's say that your business owns 3 coffee shops in a big city, and your 3 coffee shops are fairly close together in that city. Possibly, because they're located so quickly, when one coffee shop gets busy, you send employees over to that other coffee shop. Or if somebody runs out of some particular type of coffee, it's really easy to rush supplies back and forth between these 3 little coffee shops. And because you're so close, and because you've really commingled the operation for these companies, it's very likely that you can't really do very good separate accounting for these 3 little coffee shops. In fact, what you probably have to do, just because of the way you're running the businesses, is report the results of operations for the 3 coffee shops as one part of your business, because the transactions are so commingled. In that case, each one of those coffee shops would not qualify as a business component. It would be difficult to report the operations of just one coffee shop separately because your accounting is so commingled. So in that case, if you only sold one of the coffee shops, it would not be a discontinued operation because it wouldn't meet the definition of a business component. On the other hand, you could have somebody else who owns 3 coffee shops, and they have very clear separate accounting for each of those 3 divisions of their business. If that other business sold one of the coffee shops and it represented a strategic shift for the company, then that would qualify. That sale of that coffee shop would be reported as a discontinued operation. Well, let's assume that a company does dispose of a part of their business and it qualifies as a discontinued operation. What items would get reported in the section of the income statement labeled discontinued operations? Well, 2 things. You would want to isolate from all of the other transactions of the business the results of the operations of that discontinued component up through the date of disposition. In addition, you would separately state any gains or losses on that sale of that business component, so that net income from continuing operations doesn't include either one of these items. Now, sometimes a business has put a business component of theirs up for sale. It's held for sale at the end of the year. It just hasn't been sold yet. When that happens, generally accepted accounting principles say, well, even though you haven't sold it, there's a good chance that that business component won't be around for long if it's held for sale now. So we think you ought to give investors that information and let them know that that's happening. And so if a company has a business component that's held for sale at the end of a year, they will separately state on their balance sheet what the assets and liabilities are from that business component that's held for sale. In addition, even though they haven't sold it yet, the earnings related to that business component are actually reported as discontinued operations in the year that it's held for sale, as well as in the year that the component actually gets sold. One important aspect of reporting discontinued operations in a way that it will be useful for the reader of financial statements is that we have to do what's called intra-period tax allocation. And basically that means if we want the business to know what income from continuing operations is, or what income would have been if the company did not have that business component that they sold, then we need to show income from continuing operations net of the tax effect of that income, and we need to show tax expense separately on the results of discontinued operations. So basically we do two tax computations, one for income from continuing operations and one for the discontinued operation, and that way those two parts of the income statement can stand alone. Let me show you an example here, and there's some companies have some freedom to report this in slightly different ways, but it'll generally look like this. So in this case, we're assuming that the company sold a component of their business. It qualified as a strategic move. The discontinued operation generated $10,000 of net income before it was sold, and the sale itself generated a $50,000 loss. We're also assuming that the company has a tax rate of 20%. First of all, if you take the $100,000 of income from everything other than the component that was sold, and you add it to the $10,000 of net income from the component that got sold, you get $110,000. If you subtract the $50,000 loss on the sale, you get $60,000. So if we didn't have any separate disclosure requirements for discontinued operations, we would just be reporting, the company would just be reporting net income before tax of $60,000. The $100,000 plus the 10 minus the 50. Tax expense on that $60,000 would be $12,000, $60,000 times the tax rate, and net income for the company would be $60,000 minus $12,000, or $48,000. Up here is how the company would actually have to report this, because in this case we're assuming that the sale qualified as a discontinued operation. Notice that we're still reporting $48,000 of net income, and we're still reporting $12,000 of overall tax expense. There's $20,000 here, $2,000 here, that's $20,000, $22,000, and then this is a tax benefit. Think of it as like a tax refund or negative tax expense. So $20,000 plus $2,000 minus $10,000 gets us to our overall tax expense of $12,000. But that $12,000 of tax expense has been allocated to our two sections of the income statement, $20,000 up here and $8,000 down here, between the $2,000 of expense and the $10,000 of the benefit. If you look at how this is reported, we take our income from continuing operations and simply multiply that by the 20% tax rate, and that gives us the $20,000 of tax expense. Income from continuing operations after taxes, therefore, is $80,000. If the company had never owned this business, they would have had income of $80,000. So this is the income that is more likely to be there next year, and that's why this is an important number for investors to be able to see. The purple section here reports the results of the discontinued operations. In this case, we split it into two different categories. That's not always necessary. There's other ways to disclose the same information. The $10,000 of operating results generate their own $2,000 of tax expense. 10,000 times 20% is the $2,000 of tax expense. So the $10,000 minus the $2,000 is $8,000 of income after tax for operating results. There was a $50,000 loss. That $50,000 loss would generate 20% of that, or a $10,000 tax benefit or negative tax expense. It offsets other tax expense. So that loss minus the $10,000 tax benefit is a $40,000 loss. Notice that taxes reduce gains and taxes reduce losses. The $8,000 from operations and the $40,000 loss net to a $32,000 overall loss from discontinued operations after taking into account taxes. So the $80,000 income from continuing operations minus the $32,000 loss from discontinued operations gives us our total net income of $48,000. And again, remember, the benefit of separating out the results of the discontinued operations and doing separate tax computations is this really gives the reader good information. Next year, the reader can expect to see, if the company had the same kinds of transactions, $80,000 of net income instead of the $48,000 that they see in the current year. Well, recall that companies are required to report earnings per share on the face of every income statement. When a company has a discontinued operation, the reporting for earnings per share gets a little bit more complicated. Companies need to report earnings per share separately for each of these items, for their income from continuing operations, for their discontinued operation, and then overall for total net income, as we've seen previously. Let's look at another example here, and we'll demonstrate both the intra-period allocation of taxes and the requirements for earnings per share in this pretty simple example. So first of all, let's assume that this company has 10,000 shares of common stock outstanding, and that $10,000 or 10,000 shares of common stock has been outstanding throughout the entire accounting period or throughout the entire year. They had a $10,000 gain during the year, and in this example we're going to assume that the gain was just from the sale of some old equipment, and that type of gain, of course, would not qualify as a discontinued operation. It's just one other item that's listed on the income statement. So they had revenues of $200,000, expenses of $120,000, and a gain on sale of $10,000. Their net income before tax is just those things added up, or $90,000. If we assume a 30% tax rate, 0.3 times 90,000 gives us $27,000 of tax expense, and net income is $63,000. 63,000 divided by 10,000 shares of common stock gives us our earnings per share of $6.30. Well, now take a minute and see if you could redo this income statement with one important change. Let's assume that the $10,000 gain was a gain from the sale of a discontinued operation. So maybe they had a business component and it was sold the very first day of the year before any other operations had been transacted. So that $10,000 gain on sale is the result of the sale of a discontinued operation. Now what would that income statement look like? Try it on a piece of paper, come back, and compare your answers to mine. Well, it's a lot longer than the other one was, so we know that one of the things we would need to do here is separate out that gain from the sale of the discontinued operation from all of our other transactions that weren't discontinued operations. So we would report the revenues and the expenses in the continuing operations section of the income statement. So revenues minus expenses gives us income from continuing operations before tax of $80,000. The income tax on net income from the continuing operations is 30% of 80 or $24,000. So this very important subtotal here is net income from continuing operations, or $56,000. Next, we report the discontinued operation net of the appropriate amount of taxes. It was a gain, a $10,000 gain, so that gain would have a $3,000 tax attached to it, 30% of 10 grand. The $10,000 gain net of the tax expense of $3,000 is a $7,000 gain. So $56,000 income from continuing operations plus a $7,000 gain from the discontinued operation gives us net income of $63,000. Notice that we have total tax expense here of $24,000 plus $3,000 or $27,000, and that's the same thing that we saw on the previous income statement. So here we've properly reported discontinued operations in its own separate section of the income statement, and we've done the tax computation for each section as required. The other requirement is to report earnings per share, and because we think it's important enough to separate out the discontinued operations on the face of the income statement in this way, we think it's also important enough to give readers that same information in an earnings per share format. So we would compute earnings per share from continuing operations as 56,000 divided by 10,000 shares. Earnings per share just from the discontinued operation, 7,000 divided by 10,000 shares. And earnings per share from overall net income, $6.30 as computed earlier. And you can see that because we're using the same shares for all of these computations, the math 560 plus 70 cents equals our $6.30 down here. And that way investors who are focused just on earnings per share also have the benefit of using the number that makes the most sense to them. I hope these examples were useful for you.